Imagine waking up tomorrow and 21% of the world's oil supply has simply stopped moving, ships sitting idle, refineries running dry, energy markets in freefall. That is not a Hollywood screenplay. That is the reality playing out right now in a narrow strip of water called the Strait of Hormuz. And while everyone is watching oil prices, something far more interesting is happening in gold and silver. Gold is holding at 4,867 per ounce. Silver just punched above $80. And both metals are being controlled by invisible strings tied to a waterway most people could not find on a map. If you think this is just an energy story, you are sleeping on one of the biggest precious metals setups of 2026. Stick with me, because by the end of this video you are going to understand exactly what is happening, why the metals are moving the way they are, and, most critically, where silver is likely headed next. Let's start with the geography, because location is everything here. The Strait of Hormuz is one of the most strategically critical maritime choke points on the planet. Roughly 20% of all the oil that powers the global economy passes through its waters every single day. We are talking about a channel barely wider than the distance between two highway exits, and right now, that channel sits at the center of the most intense US-Iran standoff in modern history. Here's the timeline so you know exactly how we got here. The conflict ignited on February 28, 2026, when US and Israeli airstrikes hit Iranian targets. Iran retaliated by effectively shutting down commercial shipping through the strait. The total closure threatened to cut off nearly 25% of the world's seaborne oil, a scenario that has already pushed Brent crude above $111 per barrel. The International Energy Agency, which does not reach for dramatic language lightly, called this the largest supply shock in the history of the global oil market. The largest ever. That is the magnitude of what we are sitting in the middle of right now. Now here is where precious metals enter the picture, and it is not as simple as most people assume. The conventional wisdom says conflict happens, gold goes up, safe haven demand, flight to quality, textbook economics, and yes, that played out to some degree. But what actually happened in gold and silver over the past 6 weeks is far more complicated and far more revealing about where we are in this market cycle. When the Hormuz blockade first tightened in early April, gold did not simply shoot straight up. Instead, it got caught between two massive and opposing forces, pulling it in different directions simultaneously. On one side, you had the geopolitical safe haven bid, investors terrified about a Middle East war scrambling for the oldest store of value in human history. On the other side, you had the inflationary consequences of the very same crisis reinforcing a hawkish Federal Reserve, raising the opportunity cost of holding a non-yielding asset like gold. That is the key tension nobody is talking about loudly enough. Oil spikes drive inflation. Inflation forces the Fed to keep rates high. High rates make gold less attractive because gold pays you nothing while a treasury bill is yielding real returns. So you ended up with a situation where the crisis driving people toward gold was simultaneously creating the conditions pushing them away from it. The market was fighting itself. The Federal Reserve made its position crystal clear. It signaled it would not cut rates while oil remained above $100 per barrel. That created a paradoxical ceiling for precious metals. As long as the strait stayed closed, inflation ran hot, the Fed stayed hawkish, and gold struggled to hold above $5,000 sustainably. You can see this playing out in the numbers. Gold reached its all-time high of $5,580 on March 28th before the full naval blockade, and has since settled back to the $4,167 range. That is not panic selling. That is the market pricing in the Fed paradox in real time, and doing so with remarkable precision. Then came April 14th, and the entire narrative shifted. Gold futures delivered the strongest single-session performance of the month, surging nearly $100 in one day. Futures opened at $4,769 and climbed steadily throughout the entire session without a meaningful pullback, closing near the highs at $4,170, the strongest close in nearly 30 days. What triggered that move? Markets started betting that the Trump administration's decision to use the U.S. Navy as an economic enforcer in the Strait, rather than launching direct military strikes against Iranian soil, was actually a smarter and potentially faster path to resolution. The logic is brutally simple. Iran's oil exports account for approximately 85% of total government revenue. Roughly 90% of that production, some 2.6 million barrels per day, moves through the very waterway the U.S. Navy now controls. The blockade converted the Strait of Hormuz from Iran's greatest strategic weapon into its greatest strategic liability. When markets understood that dynamic, gold rallied with institutional conviction, not a panic spike. Now let's talk about silver, because this is where things get genuinely fascinating and where the real opportunity lives for anyone watching this space closely. Silver has had a brutal and volatile ride through this crisis. At its January 2026 peak, silver was trading at $121 per ounce. By the time the Hormuz blockade was in full force, it had fallen nearly 20% from that level. Here is why that happened, and why it matters for understanding where silver goes next. Silver is not just a monetary metal the way gold is. More than half of silver's total global demand comes from industrial applications. Solar panels, electric vehicles, electronics, medical devices, AI hardware, and data center infrastructure. When a geopolitical crisis threatens to slow global manufacturing, slow trade routes, and crush industrial output, silver gets hit from two directions at once. The industrial demand outlook weakens, and investors who might normally buy silver for safety rotate into gold instead because gold carries less industrial risk. That double pressure is what sent silver down hard during the worst weeks of the standoff. But then came Friday, April 17th, and the market flipped almost instantly. Iran's foreign ministry declared the Strait of Hormuz open to all shipping for the duration of a new ceasefire. The reaction was immediate. Silver jumped above $82 per troy ounce, its highest level since March 17th. Gold pushed to a 4-week high at $4,887. U.S. Treasury yields dropped. Rate cut expectations for the end of 2026 fell below 3.50% for the first time since early March. That is the domino chain you need to understand. Hormuz opens, oil falls, inflation fear eases, the Fed feels less pressure to stay tight, rate cut expectations revive, and suddenly both gold and silver, neither of which pays you a yield, become dramatically more competitive against cash and bonds. That entire chain happened in a single trading session. But here is the wrinkle that most commentary is glossing over. Even after Iran declared the strait open, President Trump stated that the U.S. naval blockade would remain in place until a full and outright peace deal is concluded. So right now you have Iran saying the waterway is open, and the U.S. Navy still enforcing restrictions. That contradiction is unresolved. The ceasefire is fragile. The situation is not settled. And that ambiguity is going to continue generating volatility in precious metals for weeks, possibly much longer. So where does silver go from here? There are three distinct scenarios worth thinking through carefully. The first and most important lens is the structural one, because it exists completely independent of the Hormuz crisis, and it has been building for years. The Silver Institute and Metals Focus have confirmed this is now the 6th consecutive year of a structural supply deficit in silver. Since 2021, a staggering 762 million troy ounces have been drawn out of global stockpiles to cover the gap between what industry demands and what mines can produce. That is not a trading signal. That is a multi-year geological and industrial reality. Solar energy consumption of silver alone is projected to keep growing through the 2030s. Electric vehicles, AI hardware, medical technology, advanced electronics. Every major growth sector of the next decade is a silver consumer. Even if you stripped out every safe haven investor, every central bank buyer, and every ETF allocation, the industrial floor under silver would be rising structurally. The deficit does not care about the Strait of Hormuz. The second scenario is a genuine ceasefire resolution. If the US and Iran reach a lasting deal, full reopening of the strait, a framework agreement on nuclear enrichment, some version of normalized relations, what happens to silver? Oil falls sharply, inflation pressure eases, the Fed gains flexibility to cut rates, the dollar softens, global trade routes reopen, industrial confidence returns. Every single one of those consequences is bullish for silver. Goldman Sachs has already published a 2026 target of $85 to $100 per ounce. Citi has gone further with a $110 target for the second half of the year, citing acute shortages of physical silver available for immediate industrial delivery. These are not fringe predictions from retail bloggers. These are major institutional desks with teams of analysts, proprietary data, and full access to the same supply-demand numbers we have been walking through. A lasting Hormuz resolution would likely accelerate the move toward those targets sharply. The third scenario is continued conflict or a collapse of ceasefire talks. If negotiations break down again, if the naval blockade tightens further, if a second round of diplomacy fails, silver could sell off initially as industrial demand fears spike back up. We already saw that movie in early April. But here is what is critically different this time around compared to earlier in the crisis cycle. Any sell-off would likely be shorter and shallower, because the physical tightness in the silver market is now so well established that genuine floor support exists below the surface. You cannot drain 762 million ounces from global inventories over 6 years without compressing the room for sustained downside moves. There is one number you should be watching above everything else right now: the gold to silver ratio. It currently sits at 61. The historical average is between 40 and 60. When silver is underperforming gold, that ratio is elevated and wide. When it compresses back toward historical norms, silver outperforms gold, often dramatically. We are sitting right at the upper edge of that compression zone. If the ratio breaks below 60 and continues falling, silver is officially outrunning gold, and that pattern has historically preceded some of the strongest silver rallies on record. Watch that number. It will tell you more than any headline. The macro calendar for this week is packed with potential market movers. April 21st brings ADP employment data. April 23 delivers initial jobless claims alongside the PMI numbers for both manufacturing and services. April 24 closes the week with the University of Michigan's inflation expectations report. Each of these prints can shift the Fed narrative, and each narrative shift ripples directly into precious metals pricing. Cooling inflation and a softening job market strengthen rate cut expectations. Metals rally. Hot numbers keep the Fed locked in. The ceiling holds. Here is what you need to take away from all of this. The Strait of Hormuz crisis did not create the bull market in gold and silver. That bull market was already running, built on years of central bank accumulation, global de-dollarization, 6 years of silver supply deficits, and a Fed that cut rates 3 times across 2025. What the Hormuz standoff did was pour a chaotic, unpredictable layer of volatility on top of a fundamentally strong structure. For gold, that means continued support at current levels with the potential to retest and eventually break $5,000 as diplomatic clarity improves. For silver, it means the next significant move, once this geopolitical fog begins to lift, is likely to be upward, and likely sharply, because the physical market has been tightening for 6 straight years, while the industrial demand story grows stronger with every passing quarter. A 21-mile choke point in the Persian Gulf is not just controlling oil tankers, it is setting the tempo for every precious metals trade happening around the world right now. Understanding that connection between geography, geopolitics, inflation, central bank policy, and finally the metals themselves is the difference between investors who react to prices and investors who see them coming. If this breakdown hit different, drop a comment below. Tell me which scenario you think plays out, a genuine peace deal or a prolonged standoff, and how you are thinking about positioning. If you want the weekly silver and gold breakdown every Friday with fresh data and no noise, hit subscribe. See you next week.